This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Perhaps the biggest debate in the markets today is regarding the prospect of inflation. Will the massive fiscal stimulus and money printing of the past year or so, paired with shifting trends in global trade and demographics, result in a secular shift in the disinflationary paradigm we've seen for the past 40 years? To try to answer this question and to better understand how to protect one's finances should inflation rear its ugly head again, I reached out to James Davolos, co-portfolio manager of the Horizon Kinetics Inflation Beneficiaries ETF. In this conversation, James shares his framework for approaching the issue of inflation. He also discusses the merits of not only bringing a value-based equity focus to the problem, but also the merits of taking an asset-light approach to the process. We also tackle the risks to the broader equity market posed by all of this. So without further ado, please enjoy my conversation with James Davolos.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
James, welcome to the show.
Thanks for having me, Jesse. Really excited.
Yeah, I saw the new fund that Horizon Kinetics, you guys put out, and I thought, man, this is a perfect time to talk to you about what the fund is and the purpose and how it makes sense today. But before we get into that, I'd love to just know, how did you first get involved, or I guess interested in markets and investing?
So I was a finance and econ major in undergrad, but had always been pretty interested in business, where my parents ran their own business, a small seasonal hotel on the New Jersey shore. And they involved me in some of the business operations. And so I understood unit economic costs between the variable and fixed costs of our rooms versus the small cafe. And that really translated into my interest to study finance and economics in college. But I was really fortunate I was very naive and ended up getting a great position at Horizon directly out of undergrad in 2005. And to show you how naive I truly thought that if you solved for a CAPM model with a weighted average cost of capital and you had all of your inputs right, you knew the precise price of a stock. So very abrupt end to that ideology when I started at Horizon with Murray Stahl, Peter Doyle, and Stephen Bregman in 2005, where these are really advocates of the Graham and Dodd, Buffett philosophy, very tried and true value investors, where first day on the job was reading 10Ks, and I don't think they asked me to look at evaluation or any equation or math for months, if not the entirety of my first year at the firm.
Well, I'm curious too about several things there. How did you, go about getting the job at Horizon? Because I do have a lot of listeners, I think, that are interested in a career in finance, and they think, how do I, the advice I give a lot of people is to find somebody you really admire in the business and try and go work for that person. And it seems to me, I'm big, admirer of, Stephen's work and a lot of what you guys put out at Horizon. So I guess, did you look at Horizon and the founders there and say, hey, these are guys I want to work for, or was there something else that brought you to the company?
I'd like to give myself some credit, but honestly, I deserve none. It was dumb luck. I had a tangential family member's friend who knew someone who worked in the back office at Horizon, and that's where I started, on the trading desk, where I was doing order entry. Not in the sense that you're trading for profit. It was really a more clerical job, but the partners at Horizon run a very flat organization where they allow basically anyone to attend the research meetings and anyone to read their work. But I think that's a kind of a 1 in a million scenario to end up at a place like Horizon. But I agree, if you can figure out who you want to work for, but it's also just there's no traditional recruiting in asset management, or it's very limited. Also for hedge funds, and so it's really just expand your network. And if you can find any commonality with anyone, whether it's I've seen people, but even their undergrad, or excuse me, their high school, let alone undergraduate, or anything where there's commonality, and that person might be willing to have a cup of coffee with you, I guess in normal times, or maybe a phone call or a Zoom now, but just plant as many seeds as you possibly can and just directionally understand where you want to get to. And I think that's how I've seen a lot of success stories.
So with Horizon being, you working for Horizon for 15 or so years now, obviously their thinking and their methodology, as you mentioned, has shaped your understanding of how to approach the markets. But you also came into the markets professionally, like right at the height of the housing bubble, and leading right into the great financial crisis. So, I'm just curious as to how does that experience, those first few years in the business, how does that shape the way you think about markets or approach the markets today?
I think that I definitely have a far more cautious, and I try to bake a lot of room for error into any of my valuations, but it really wasn't that way from the beginning, where I was young and the hubris was out of control, where I joined Horizon in '05, and I think we doubled AUM in each subsequent years, and we're just tremendously successful. And Murray nailed the housing dynamic, at least at the first derivative, which was the home builders were trading as if they were these perpetually high return on equity and high growing companies. But the nuance was that they had been depleting these low cost land banks for many years. So once they had to replace the land at market cost, basically the margins were going to revert to their historical very low margins. And once the cycle turned, obviously the growth was going to turn. But ever since experiencing '08 and '09, which was very difficult for all value investors, my firm included, I've always had a skepticism, and maybe too much skepticism. And also coming from my family business, where my parents weathered the S&L crisis, operating a small family hotel in a seasonal community that was really devastated by the S&L crisis. So I always look at what could go wrong first, instead of trying to look at all of these pie in the sky scenarios, which hasn't been the right approach, at least in the more recent market cycle. But I think over complete business cycles, that's probably a prudent approach.
Yeah, I mean, it seems to me that, after interviewing a number of successful, super successful investors and studying, a bunch of others, it seems like an appreciation for risk is definitely a commonality that, as I think, Paul Tudor Jones has probably said, you play defense first and let, the gains take care of themselves, is kind of a way to think about it. But I want to dig in, a little bit, well, not a little bit, but this is kind of the primary, I think, debate in the markets today is this inflation-deflation debate, or I should probably say disinflation, because I don't think we've really seen any deflation. But it seems like the disinflation debate is the center of like pretty much every discussion about markets today. Obviously, in starting the new fund, Horizon, probably sees inflation as a greater risk than most. So I guess, what is your process for studying, inflationary dynamics, and, how does that process help you arrive at a conclusion as to what to anticipate going forward?
So we are a bottom-up fundamental firm, and so we've very rarely had much of a macro overlay into our thinking, but probably 7-8 years ago, we started looking at valuations and just completely detached from anything that we felt was reasonable. And some things some businesses have outperformed our expectations, obviously, but we more and more began to believe that this continuation of easy policy was going to have consequences. But I think one of the most salient characteristics of macro investing, which we're not, and a lot of other people have far more sophisticated views on inflation dynamics, but we wanted to design something where you can benefit regardless of inflation. So there's many binary bets where you have a negative carrying cost, or you make a binary bet on CPI or different type of rates. But we really were looking for something where you could own this and do just fine under the status quo, but do varying degrees far better under higher scenarios of inflation. And I think that the other nuance of this product is that, and again, without digging into the flaws and the debates that are numerous and plenty on CPI and the construction of CPI, but inflation is this catch-all phrase that people seem to apply to anything relating to a price, which it truly does, at least in a strict definition. But in terms of the way that the Fed and a lot of the derivatives in the market are structured, it purely applies to CPI linked products and CPI linked contracts, which isn't necessarily going to be the dynamic of inflation, or at least the leading edge of inflation, in our opinion. So that was really the genesis, was looking at prices that really seem to be detached from reality, and then thinking about where could inflation hit, because I think it's beyond dispute that we've seen financial asset inflation. So where's the next continuation of this? And then how do you do it on a full cycle basis where you can compound without making that binary bet on CPI or any other price level for that matter?
Well, that's fascinating to me that, to hear you say that you kind of came to this from a bottom-up perspective. It wasn't some big macro call. When I interviewed Stephen a few years ago, I think he was the first person I interviewed for my podcast. One of the points that he made was that the rise of passive investing creates tremendous opportunities for those willing to look at the stocks that have been ignored by the indexes. So do you think this inflation opportunity and these inflation beneficiaries, arises out of this opportunity that's created by passive ignoring a lot of these stocks and sectors?
Without a doubt. And the leading edge of inflation, you're already seeing it, has been in various types of commodities, whether it's energy, precious metals, or base metals. And if you were to look at the composition of the S&P 500 today, and the relative weightings of what you could truly say to be an inflation beneficiary, whether it's energy or materials, for example, is de minimis compared to what it's been historically. But then even at that, these tend to be large, capital-intensive multinationals that are engaged in these operations. So by that sense, there's virtually none of these names in the S&P 500. So I think investors are going to have very, very little exposure to inflation beneficiaries in the index, and essentially none in these asset light approach companies that we're focusing upon.
Yeah, I mean, just the differences in sector exposures, between this fund and your average fund, are dramatic. And I want to get to the specific companies too. But, when you just look at it, I think basic materials, financial services, and energy make up about 75% of, the inflation beneficiaries fund. The typical fund has less than 20% in these sectors. So, it's positioned dramatically differently. Is it just when I think about it, I go, hey, these are clearly sectors. I mean, think financial services, right? Have been a dramatic underperformer, until very recently. But, you could think about until last summer into the fall, financial services, the yield curve looked like it was poised to really start taking off, and that should be beneficial to these. But energy, incredibly, there's no exposure to energy in any of the major indexes anymore. These, appear to me to be terrific value opportunities, but also some of the sectors that just by chance would happen to be inflation beneficiaries. So, I guess my question is, how much of that is, just pursuing these value opportunities, and how much of it is specifically this kind of macro call? Is it just kind of fortuitous that it would happen to benefit from inflation?
Yeah, that brings up a really good point, which is that everything that we own is valued and justified on a fundamental bottom up basis. And that's the biggest shortcoming of passive investing, where you've had guests that have done exhaustive work on this, and you've had Steve and seen Stephen Murray's work, where I think it's creating an incredibly fragile market structure. But the opportunity is a lot of these sectors are ignored. But I think part of the issue is also that people have had a really miserable experience in a lot of these stocks. And a lot of that has to do with A, the management of these companies, but B, the nature of these businesses, meaning the capital intensity, both in the standpoint of spending a lot of working and utilizing a lot of working capital to make a return, but then also having a low inherent return on assets that you need to lever up with debt financing in order to create an attractive return on equity. But investors over the past 10 years have had a miserable experience if you went into upstream E&P oil and gas producers, or the average gold mining company, and certainly the average base metals mining company, where there were a lot of nuances within each of these, where the base metal companies all just expanded wildly and very irresponsibly in the lead up to the 08-09 financial crisis by virtue of the China-driven EM growth, which proved to be very unsustainable. The gold miners all had tremendous success going up to the gold peak in 2011, where they were given a tremendous amount of capital and expanded very irresponsibly, and not too dissimilar with the energy companies, where it seems like a long time ago, but July '08, we had $140 crude. And then, we've had a lot of volatility in these markets, but regardless of management and the industries at large continuously pouring all of this supply in and investors' willingness to basically fund these businesses, the capital intensity, the balance sheet risk, and then the reinvestment requirements have resulted in a very, very poor experience. So that's why when we look at these, we've actually been focusing in my case, since I started at the firm, and in the case of the founding partners, for me, 15 years, for these guys, 30 plus years in these asset light companies that just so happen to be tremendous values, but exposed to these inflationary end markets.
Yeah, and I'm glad you brought up the gold miners too, because to me last year, and I was talking with my friend Eric Cinnamon about this, that the last summer, really into the fall, the energy stocks felt very much like the gold miners did in late 15 and into early 16, where a lot of them were just trading at, far below liquidation value. Tangible, 30, 40% of tangible book value in some cases for the gold miners back then. As a value investor, it's been interesting to kind of see these opportunities arising in things that, I think people have to be extrapolating the disinflationary trends of the last 40 years, indefinitely into the future to even generate prices as low as that we've seen in those sectors. I guess, what I'm thinking now is okay, this is where value has been. In some respect, the fact that investors are extrapolating disinflation into the future creates the opportunity for these inflationary beneficiaries. I guess if that's the case, that inflation is we are seeing a paradigm shift from disinflation to inflation. In terms of asset classes, equity sectors, you've probably done the work to see what are the best opportunities in terms of asset classes and equity sectors generally for investors to kind of focus on.
Yeah, one of the biggest challenges today with investing for quote unquote inflation is that there's a huge data availability problem, because we haven't had true consumer price inflation since let's say it started in the late 60s into the early 80s. And that was a very, very different global economy and a very different global financial system in terms of the interconnectedness of global markets and currencies and rates. But also you started off at a very different dynamic in terms of where budgets were, where deficits were, and then where absolute and nominal rates were. So I don't think there's it's basically unmodelable where we're at today. But I think one thing that is almost a certainty is that you're not going to do well in fixed income. I think, fixed income you can almost mathematically prove is not going to be a good investment even under moderate inflation, certainly if you're in the ag. And if you look last year, at one point you were up 25% in the long-term bond if you look at the TLT ETF. And since then, you've retraced 17%. And that shows you just the duration sensitivity of fixed income and what just a very modest move in the yield curve can do. But tips as of last night, now I looked at a generic, a Jan 15, 2031 U.S. Treasury tip where the gross yield was negative 85 basis points. So given that, you are, no matter what, you're basically going to get, if you hold that to maturity, you're going to have a negative real yield if held to maturity. So the bet here is you buy a tip thinking that inflation expectations are going to spike, therefore you can get this short-term gain. But part of the problem with that is right now you're paying about an 80 basis point premium based on the current break even relative to the most recent annualized inflation number. But it's not that simple because you have two other factors influencing what the price is going to do. One, what is the premium going to look like relative to trailing inflation? So the expectation versus current. But also the tip is always going to be anchored by the yield on the 10-year. So if the 10-year moves more than CPI, you can be directionally right on inflation and actually lose money. Obviously a lot of sophisticated people are putting on steepener trades where you're betting, a steeper yield between the 10-2, which it seems like right now with how flat the yield curve is, that would help. And then other people do it with leverage. But, a lot of people that intuitively think, hey, I'll just buy a TIPS or I'll buy a TIPS ETF, that's really not going to get you much of anywhere under most scenarios that we look at. So then when we look at what other companies can benefit from inflation, I was, courtesy of Michael Burry, he just posted the 1980 Berkshire Hathaway chairman's letter from Warren Buffett. And he speaks at length about the dynamics of inflation as a tax. But I think one of the most salient points that Warren Buffett made in 1980 is that for the capital of the business to be truly indexed, the return on equity must rise, meaning that business earnings have to go up in proportion to the price level, but without any requirement for additional working capital or CapEx. And that's going to be really, really difficult for most companies, even a lot of these technology companies and companies that have a ton of operating leverage, a ton of pricing, and theoretically have tremendous scale. That's a really difficult dynamic to focus on. So to go back and looking at equities, because I think fixed income is just, a minefield. One of my colleagues calls it all risk and no return. But again, when you go back and look at these areas that historically, these finite, high quality, hard assets is really what we look at. And whether it's land or royalties or precious metals, you're looking at the highest quality, the lowest variable cost, so on and so forth. And if you have a very, very aggressive, strong opinion that, let's say, gold is going to go to 2,500, you should buy the most leveraged junior miner that's not producing yet. I mean, I would say still stay with good jurisdiction, geopolitical and management, but that's your big call option where you can make a huge, binary return. But if you're not 100% confident in inflation or the underlying drivers of any of these, what we call inflation vectors, so the end market, whether it be a niche energy, land, precious metal, any of these different markets, the better way to really play this for the long term is to play it through these asset-light businesses where they can continuously reinvest capital at higher rates. In many cases, they have tremendous operating leverage and very low amount of balance sheet leverage. So, we look at it in terms of figure out where in the equity markets you want to be, but then find the advantage business models with good management and then trading at good valuations.
Interesting. I really appreciate that you say that it's really difficult, in fact, unmodelable to understand, how best to protect yourself against inflation because, we look back at, how many really inflationary episodes have we had in modern times history doesn't necessarily repeat. So if we look back and say, from 1968 to 81, these are the things you wanted to own. Well, that might, not help us very much in determining what is, going to work if inflation, picks up again going forward. And I also appreciate that, you're saying, hey, we're going to use the traditional kind of margin of safety process in analyzing securities to try and protect against those risks that we don't appreciate. One of the things that that I think about when I listen to you talk about all this stuff is that many people are utilizing investment strategies today that are based on a back test that goes back 20 years or even 40 years and doesn't include any inflationary type of dynamic at all. Do you see that as a risk that there just is tons of money out there kind of leveraged to back tests that are completely predicated on disinflation?
Yeah, it's really concerning and it's really scary, especially people that are looking at the realized vol in equities and inherently volatile asset classes, where I still remember in one of my first years at our firm when we were meeting with a large endowment or pension fund and they asked about us managing volatility. And one of my partners said, there's a certain amount of volatility that you have to accept as the cost of entry into a higher returning asset. So much of the financial services industry is spent just trying to smooth or the illusion of smoothing volatility or eliminating volatility. And, obviously if you don't have to mark to market, that's a huge advantage to just say I have no vol. But these back tests are very dangerous given the preconditions that we're experiencing today are really unprecedented. And, one thing that I was somewhat in the dark about was it seems like all of these financial institutions that are maybe not the most sophisticated people operating them are basically operating these risk parity strategies to basically, mimic like an all-weather type of strategy where they're bouncing in and out of asset classes based on realized vol and trading and trailing returns. And it seems like eventually if everybody's marching to the same beat of the same drummer, following the same vol, tail wagging the dog type of numbers, you're setting up for a very, very fragile market structure, especially when you add in the passive and then the momentum. And you're seeing it, day in and day out. I mean, this morning, and then look at where we came from this morning to where we're at today. So, the best word I can think of to describe everything is just fragile.
Yeah, it's such a great point too, because it makes me think of what we saw in GameStop, right? To me, I was looking at some of these stocks, the Bed Bath & Beyond was one in particular I was looking at that had almost 100% of the float sold short. It was trading at a fraction of its liquidation value, in my view. And I thought, how could, GameStop's another good example of a stock that, got so cheap and was so overly shorted. You make the point that a lot of these funds are optimizing for volatility and, and what have you. To me, the only way that you can stay short something where 100% of the float or more, in the case of GameStop, is sold short is you've just extrapolated the last, 5 years of returns, out for the next 5 years. I mean, to look at the risk of being short something that is such a hugely crowded trade, to me is just kind of maybe representative of some of these other trends that have been extrapolated, like, not necessarily being 140% short, an individual stock, but you're so highly leveraged to a trend that has gone so far beyond, where it should have been able to, where it should have reversed, that, the eventual reversals can be very, very dramatic in kind of a GameStop type of fashion. Would you think that's, what do you think? Do you see kind of the same type of risks in a lot of these trades?
I do, and I think one of the most interesting nuances of the hedge fund industry as it's operated today is think of probably you could say Jim Chanos is easily one of the top five short sellers of all time, and all he looks to do is basically break even on his shorts over a longer period of time, say 5 to 7 years. And then if he can basically use that to margin and double his long, you basically get double the S&P with half the vol. And I think that that's the model that a lot of these shops are basically trying to emulate. And obviously, there's a lot of different nuances, but when everybody's basically managing around a vol number, it creates excesses to the upside and to the downside. And I could certainly see some of these names where it's some of these names. I won't get into specific names, but I think you could guess that just keep going up beyond any semblance of reality. And I just keep thinking the next time that there's a reasonable down day, there's just an air gap. There's just no one there left to buy it. But then seemingly, it comes back in. So market structure is really an enigma today. And I think that GameStop put a microscope on it where there's a lot of guys out there that study the gamma and all of these other different types of dealer hedging where, again, tail wagging the dog if with options dealers then having to cover and then buy the underlying. And then there's momentum. And then there's these people with VAR models and risk parity models. And market structure, it just does not seem like there's any such thing as price discovery whatsoever, at least in the short term.
Yeah. Yeah. And I guess the analogy I'm trying to make is I think, you had to have some kind of algorithms. That's the only way I could try and explain it, because I don't think a rational person would be willing to short something where 100% of the float is sold short. It has to be algorithms that are looking at, okay, this stock, has trended this direction over this long. We can probably extrapolate that for the next year or two or what have you, whatever the time period is. I'm just curious. I have to imagine that there are similar strategies out there, and maybe risk parity is one of them, that looks at the last 20 years or 40 years of disinflation and, has extrapolated that out into the future. And that's the only reason that allows them to get so leveraged towards these trades that benefit from falling interest rates or falling inflationary trends. It's just, I think you probably addressed it through the risk parity question, but I just imagine there have to be other strategies out there that are similarly at risk to, a change in the inflation paradigm. Let's get into, speaking of inflation, and you brought up the gold price. What are your views on gold? It looks like in the fund, you guys are primarily focused on the royalty companies rather than the mining stocks directly. Is that because you have more of a neutral view on gold itself, or why is that?
We think that basically anything fiat is going to come into question over the next couple of years where, just like you said, no one rationally could be shorting something at a third of tangible book with 100% short interest. Obviously, we know who it is and we know different dynamics are at play, but what rational free market participant would be buying a 10-year U.S. Treasury at slightly over 100 basis points today when everybody seems to be thinking we're going to be running at 2% inflation? And obviously the level of insanity gets even higher when you extrapolate that into different. I haven't looked lately what the latest number of the global sovereign debt with negative yield to maturities are, but I think it's somewhere in the vicinity of 17 trillion. So obviously there are non-fundamental forces at play that are influencing that. And to the extent that the average saver cannot and will not lend their money to the government at 1% a year, 0% a year, negative whatever in real terms, they're going to look for other stores of value. And I think one of the most tried and true stores of value throughout hundreds and hundreds of years has been gold. So there's also the fact that the industry was starved of capital. So you saw basically a lot of these miners and blow up after really kind of going aggressively into the 2011 gold peak where, I have an interesting statistic, and these numbers were run through yesterday, but since the August 2011 gold peak through yesterday, and this was since through 2011. Gold was down 6% over that full period. The GDX, the gold miners index, was down 48% over that period. And Franco-Nevada, the largest and most liquid gold royalty company, was up 160%. And so Franco's assets outperform, but also they're able to allocate capital most efficiently and most effectively at the bottom of the cycle. At the top of the cycle, at 2,000 an ounce, nobody's calling up Franco-Nevada where they need financing to basically slap a royalty on top of their mine to get some extra capital in and complete the mine. And this dynamic really enables these businesses to compound over time also, because if you look at the reserve life of a Franco-Nevada, it's anywhere from 2 to 3 times that of the average gold miner. So you get a lot more duration in the asset base. You have the low asset intensity and then the ability to basically capitalize through a full market cycle. So I would say personally and as a firm, we're certainly pragmatic about the price of gold. I mean, certainly short term, it's impossible to say, but we really love the royalty business model to play this over many business cycles. So, we're not trying to basically make a one-time trade and say, buy gold to hedge inflation today. These businesses, if bought and managed correctly, can really be permanent allocations into your broader asset allocation mix.
And so, maybe for the audience's benefit, could you explain the royalty business model a little bit, more, and how you think about valuations for these companies?
Sure, and I'll caveat it and say that there's a fairly different business model between energy royalties and precious metals, where most precious metals royalties are actually what are called streaming agreements. And to simplify it, let's assume a gold miner needs to build a mine and they require $100 million to do that, but it's going to take 3 years until they have first gold. If you take on conventional financing, historically, it would have a very high cash interest coupon rate, which if you even had the cash, you're certainly not going to have cash from operations. It would be prohibitive. So a stream would basically say, I'll give you the cash up front, and then for the life of the mine, there's a fixed proportion of gold, whether it be an absolute amount of ounces, a percentage. And these have gotten very complex now, where there's waterfalls and caps and limits and different duration. But to simplify, let's say for the life of the mine, I get 15% of all of your production. But if gold's trading at 1,800, I buy it from you at 300. So it's a deeply in the money option on all of this production. And so basically when they underwrite, they're underwriting two things. One, okay, what's the interest rate that I'm going to underwrite at under flat or static gold pricing? But one of the more difficult components of valuing these companies is that in many cases, these royalty agreements compose the entire mine plan. So in the case of Franco-Nevada, if this mine is an open pit mine in a vein in the Andes Mountains, and this is the first mine, they're going to try to structure these where they basically have a call option on any other expansions of that mine. So Pierre Lassonde is famous for saying, where do you find gold? And a lot of geologists and people in the audience would give him these highly technical answers. And he said, you might be right, you might be wrong, but you find gold where you already found it. So expand the mine down the road, down the vein, on the surface, but also now at these prices and with technology, you can also do subsurface mining where you can make money even below 1,000 an ounce. So there's this call option on the additional production that is pretty hard to value. But so if you look at these NAV numbers that people put out, they might use a lower discount rate in order to justify the quality of the business. And commonly people will say that these companies traded a premium to NAV. But I think it doesn't consider a couple things. One, let's just think of the price of gold. If you looked at the throughput and the massive reserve base that is within Franco or Wheaton's portfolio, if you were to take all of that gold over the next 50 years of potential production and call up an investment bank and say, can you quote me an option to basically have upside on all of this gold over the next 40 years using a Black-Scholes model, I think their computer would break. So how do you value that? But then also, how do you value the known unknown, which is the expansion plan in the mines itself, where since Franco reemerged as a public company, I think it was in the end of 2007, if you looked at what their proved and probable reserves were on that day, forget the other measures of reserves, they've extracted all of that from that original asset base. I'm not including any new additions to the assets. They've extinguished all of the proven and probable and replaced all of it and then some. So now they have more proved and probable from that original asset base after extracting everything that they said was there back in 2007. So there's a lot of nuances to these companies where we make certain assumptions about gold prices, silver prices, production levels, and then looking out into the future. And obviously there's some assumptions about the management's ability to reinvest that capital. Energy is a little bit more simple because instead of providing financing to a mine, energy royalties, and this also tends to be the case with iron ore and other base metal royalties that you'll see in the portfolio, is a function of land ownership. So a royalty in its truest sense is basically just a proportionate percentage of the realized product which is extracted. In many cases, is completely free and clear of any operating expenses or any proportionate costs whatsoever. In some cases, there's some minor ad valorem tax participation, but in that case, it's fairly easy because with technology today, it's fairly easy. So with Texas Pacific Land Trust, they RS Energy audited and gave them what I think is a fairly conservative estimate of the recoverable resource under their land. So if you make a few assumptions about what other companies are going to spend to extract that oil and gas, prices of oil and gas, and then the timeline for it to be extracted, you basically just do a DCF back to present day. And, we're going to work, depending on our confidence level, anywhere from a 7.5% to a 12.5% discount rate. So, the beauty of that is if you're right, not only are you buying it at a discount, but if it goes to fair value, you're compounding somewhere between that range for many, many years, which obviously is not an easy number to hit in this market. So really great business model where the operating metrics of these companies actually compare favorably to the leading tech companies in the world, where you can see energy royalties with 80 to 90% operating margins. And similar with the gold guys, you can see anywhere from 45 to 65% operating margins. And then, as I mentioned, they have these very, very vast reserve bases. They can convert almost all of that into free cash flow.
And so that to me is the argument for these asset light companies, is that, they have huge returns on, invested capital. And, I also love to hear you say, I just got to come back to it. You said, using the discount rate in your models of 12% plus. I was reading something in the Wall Street Journal, and they were talking about, interest rate risk in the equity market. And they said, a lot of analysts use the 10-year note yield, as in their discount models. And I thought, oh my, it was 65 basis points a few months ago. You just come up with incredibly ridiculous valuations for equities. And I guess it probably helps to explain some of the valuations we're seeing. But yeah, using a 12%, like you said, if you're right, you generate terrific returns. If you're wrong, it's that margin of safety concept, right? How much risk did I actually take, by buying something at a discount. So we've been talking about, the security selection process and actually, looking at the individual stocks. It's clear, that it's asset light on the, on that gold side. Is that true for the energy side throughout the portfolio also, or is there real exposure there to actual, exploration production companies, or is it, like you said, more on the asset light side there too?
Yeah, and so this is one thing I'll kind of delve deeper into, but the one bucket of the fund is in these direct beneficiaries where they have the direct exposure to the inflation vector, and whether it be energy or precious metals or base metals, or in some cases land. But in every example, somebody else is spending all of the money for you to make the money. So with energy, in the case of Texas Pacific, it's Chevron spending 10, 15, $20 million per well, and then TPL basically just skimming their portion right off the top. Same thing with Franco-Nevada, where mega multinational gold miners and even some diversified base metals that are doing copper, they'll get a stream, where these guys are spending the billions of dollars and they just get the royalty right off the top. The second bucket of the fund, which is almost the exact same size as the direct beneficiaries, is what I call the indirect beneficiaries, where they're capital light businesses with indirect exposure to these inflation vectors. And I think a great example are financial exchanges, where, for example, the Intercontinental Exchange or the Chicago Mercantile Exchange, basically all they are supercomputers that are matching buy and sell volumes. And then obviously they have the clearinghouse and data business as well. But if you think about what would happen in an inflationary cycle, you would have tremendous interest rate volatility and the requirement for people to hedge out their rates. You would have tremendous currency volatility, and presumably you would have a lot of movement within both hard and soft commodities. So your energy, your metals, your precious, and then also in the softs, whether it's ag and some of these other commodities. And these exchanges, they thrive on volume, and volatility is the best friend to volume. So in an inflationary cycle, imagine rates, currencies, oil, cotton, hog bellies, soybeans, gold, copper, all of this stuff having tremendous movement and volatility, which requires both hedging and speculation. And then these supercomputers, what do they need to do to process another $1 trillion of volume? Maybe you plug in another server. So the operating margins there are enormous. And in a sense, they're actually counter-cyclical. So the market has vol, and you have all of these destabilizing forces where they're having the best year in their history, while I would imagine that a blowout in the 10-year or a blowout in risk and currencies would be pretty harmful to the broader equity market. Where when John Hussman was on, I thought it was fascinating, where he calculates the duration. I've tried to do this myself and kept getting stuck, but he calculates the duration on the S&P 500 of 60. So sensitize that to 100 basis point move if people actually were using this 10-year as a benchmark. I mean, it's ugly. 60 years of duration, it would be really ugly. Yeah. But then some of these other indirect companies, so data companies, where they have exposure to these inflationary end markets, where they're in the middle of probably being bought by S&P, but IHS Markit, where their biggest customers are in credit markets, are in energy, are in mining, and then are in automotive OEMs. So again, as those businesses thrive and flourish, they have more and more volume, more and more pricing power, and a lot of that flows to the bottom line, because it's really just a financial database. And similar industries with insurance, with Verisk Analytics, where I don't know if you've seen what's happened to insurance underwriting, the underwriting premium cycle, both in terms of volume and premiums, if you look at the Marsh and McLennan Index. Other ways to play asset light within financial services and so that's what's exchanges and data. But Marsh McLennan brings up a great example with brokers. So any industry where there's an inflationary end market and there's higher volume and higher pricing, the broker just takes a cut. So Marsh McLennan in insurance, or Clarkson in shipping. One last one that I think is also worth touching on is a lot of products that do try to use equity that don't go into these commodity areas for inflation are global listed infrastructure and real estate. But I would argue they've already been dramatically inflated by financial asset inflation, where how much can you really benefit from a 3 or 4% inflation number if you're going into a project or a building at a 3 or 4% cap rate? Chances are any increase in cash flow would be offset by your cap rate expanding. But what about owning it asset light through somebody like Brookfield Asset Management, where they have co-investments within the products where there's a big book value component of NAV, but there's also, you're the GP on this enormous pool of both permanent and semi-permanent capital as the global leader in real estate and infrastructure investing, where much happier to basically have that operating leverage than tying up a ton of capital in a bridge or a port or an apartment building. So I think that second bucket of indirect beneficiaries is really interesting, that not a lot of people have appreciation for the true drivers of these businesses, and certainly under inflation.
Listening to you, discuss these individual, stocks, individual opportunities, and then also the framework, I guess, or the purpose of the asset light kind of focus, makes me think of another interview I did a couple of years ago with Diego Perillo. He talks about bubbles and anti-bubbles, and one of the anti-bubbles that he's written about is volatility, and how volatility has been suppressed. But another one I think of an anti-bubble is probably inflation. Things that have been, that are kind of the inverse of the bubble in, the bond market is, if disinflation is the bubble, inflation is the anti-bubble. But even so, from that standpoint, it seems to me this portfolio is essentially positioned to take advantage of these anti-bubbles in volatility and inflation at the same time.
Yeah, I think that's a really good way to put it. I love Diego and have followed a lot of his work over the years, and it's easy when you're looking back at 5-year numbers to pat yourself on the back. And, I can't tell you how many people are on Twitter boasting their 50, 80, 100, 300% returns last year, where, rising tide lifts all ships, especially if you were kind of in the zeitgeist names. And, I think some of these green technology stocks, both in terms of anything in the renewable sphere, and I don't know if it's because of ESG, I don't know if it's because of the zeitgeist, but some of these valuations make the cannabis bubble of a few years ago, both in terms of the valuation, but also the total market cap, look like nothing. And so when you think of it in the context of an anti-bubble, what happens to this portfolio and what happens to these types of stocks on a fundamental basis, where they could hold up, if not thrive, and a lot of other companies would be in really tough shape.
Yeah, and that's what I was thinking about while you were speaking, before, was that, a lot of people ask me, okay, great, if commodities are so cheap relative to financial assets, how do I get exposure? And it's difficult to own commodities directly. And so you want to focus on, maybe commodity focused equities, but you've taken it another step, which is, okay, let's focus on asset light, commodity focused or commodity related equities, because they'll benefit from traditionally, just commodity focused equities will be highly leveraged to whatever the cycle in that underlying commodity is. But these asset light versions, like you've been, saying for half an hour or so now, the real benefit of these is that they're not necessarily as leveraged to the underlying commodity cycle so much as they can take advantage of the volatility in those cycles.
Yeah, and particularly the exchanges will do just phenomenally well with volatility, but then also a lot of the royalty companies, where Franco and Wheaton have been, and some of the more modern, well-managed energy royalty companies, they thrive on volatility, where they can then put capital to work. In the case of the precious metals, investing in companies that need money to help them finance mines, and in the case of the energy royalties, they can buy up royalties from stressed or distressed sellers, where there's still a tremendous market size of energy royalties that are private and stranded or semi-stranded, meaning a large family owner or a private equity owner or some time sensitive holder that would probably want some sort of exit. So I think that these types of assets are really going to mature and grow the entire market size really markedly in this next cycle, because of the quality and all of these characteristics that we have spoken about with these types of asset-like business models.
Yeah, and so the other thing, looking at the portfolio, in terms of portfolio construction, it appears to be, pretty highly focused into a smaller number of names. What's the attitude towards diversification?
So right now we have about 35 names, and typically our max position size at cost will be 5%. Minimum would be anywhere from 1 to 2, and that's a function of conviction as well as liquidity. And historically at Horizon, we've always liked to allow our portfolios to concentrate within our best ideas, but I think within the context of an exchange traded fund and active ETF, we'd like to be a bit more diversified, both in terms of names, and then also we really want to spread it out and try to touch a lot of these inflationary end markets that we think are important to have exposure to, which actually brings up a good point about the third bucket in the fund, because there are really interesting niche markets that we want exposure to, but it's almost impossible to get asset light exposure. So we just look for advantaged business models. And this is going to be a smaller component, but let's call it 10%, where we either just love the business model and the end market, or there's just such a tremendous asymmetry in the return profile that we're willing to go in something that's a bit more asset intensive. And I think a quick example is agriculture. It's almost impossible to get asset light exposure to ag, but if you could look at some of these really interesting grain processors, so think ADM for Archer Daniels Midland. And then also within ag, something that has a wide outcome where if you do get a commodity cycle and an ag cycle, certain fertilizer companies could really have many, many multiples of growth. So, there is a willingness to go into those businesses as well.
And, another thing I noticed from the portfolio is it looks like the biggest underweights are in consumer cyclical, communication services, industrials, technology. Is that more of an inflation call or a valuation call or a little bit of both?
I think a lot of it has to do with, we want tangible assets that are finite, where a lot of the pricing power and a lot of the leverage of these businesses to have the ability to benefit from inflation is going to basically be a function of them having a finite asset and the ability to scale upon that physical asset. So, one of the things we focus on internally here in other products is, quote, hard assets. And it's really difficult to push price in a lot of those industries that you mentioned. A lot are very capital intensive, and it's somewhat ambiguous how even some of the really, really high quality businesses would perform in inflation by virtue of that duration, where hard to argue that Microsoft wouldn't be able to push cost. But if you look at the multiples and then you look at, okay, how does that affect their SG&A? Because wages are going to have to go up. How does it affect their cost of capital? How does it affect the valuation? So it's more a function of kind of how the businesses are structured and how they could benefit from this earlier stage of inflation, where I do think, going back to somewhat of a macro lens, the leading edge of inflation today, you're seeing it in these finite assets. And I think, I'm not sure if you've discussed it on other podcasts, but if you look at these collectibles, these finite assets, whether it's fine art, or now you're seeing these records being broken in art auctions, but also rare wines and rare whiskeys and baseball cards and collectible autos. So that's kind of that inflationary store of value with something that's finite that we really want to basically have that exposure to.
And it's interesting to me. I'm glad you brought up Microsoft. You're also the co-manager of the Kinetics Internet Fund, right?
Yes. So I manage that under Murray, but yes, I'm on that fund as well.
Okay. Yeah, and so when I look at the holdings in that fund, it's not necessarily what you would imagine the typical internet fund holding. And I look at some of the competing funds. Is that because you're concerned about, valuations, duration in a lot of these names, and especially in the growth category?
Yeah, and let me give you a little bit of history where The Internet Fund, they basically created out of the firm long before I joined in the late 1990s. And, they caught lightning in a bottle there where then, that was, the first iteration of what we're living through now. And guys that were around back then tell me that this is actually bordering on more painful as a value manager than back then. Because our core business was value stocks, whereas we had that one product where we noticed this secular growth. But they've said the duration and magnitude of this cycle are more painful than 99. So people that haven't been through both, I think it's an interesting data point. But even within the context of recognizing the enormous potential of the internet, the managers and the partners of the firm did not want to go into these companies that really had no scalable no tangible value add or business model. So they weren't buying hardware or components. They weren't buying pets.com or whatever the other names were back then. They were more focusing on, okay, what companies can benefit from connectivity where we can somewhat think about this from a valuation perspective. And they ended up having tremendous returns early on and then holding a lot of cash towards the end, which then didn't completely isolate the fund from the eventual drawdown. But it's always had that mentality of kind of inverting the conventional wisdom. And I'd say 100% look at our firm as contrarians and look at, okay, what's a contrarian approach with how I can play this on risk adjusted terms?
Gotcha. I mean, it just strikes me as, if, a traditional value investor were to approach the internet sector, what would it look like? Well, just look at the fund and you'll get a good idea. And it is definitely contrarian, especially within that sector. I'm going to totally change gears here. Between co-managing the two funds, I think you probably manage, a number of separate accounts or co-manage also. Is there anything you do kind of outside of that to get away from the markets, achieve a sort of like a mental reset?
Yeah, it's been really, really difficult during COVID here, being on lockdown, and I have a young daughter, and she's been kind of the greatest experience through this lockdown, and fortunately, she's a little bit too young to understand what's going on. But I realized a couple of years ago, I got caught up with all of my reading, and I love to read, was financial. I was basically reading biographies and all these next great finance books, and so I really took it upon myself to start looking into things that stimulate other parts of the brain, if you will. And so, things that through COVID I've explored that I've really been interested in, fascinating with. Where I grew up on the ocean in southern New Jersey, so I've been buying every book I can get my hand on well, it's nonfiction, but very interesting historical accounts of pirates and whaling and these old historical accounts, and also kind of a new fascination for wine and researching winemaking and different culture and different climates and terroirs and things like that, where I think it's really important to diversify your mind, but then also beyond that, just physical activity. I'm an avid runner and yoga and a very bad but aspiring golfer.
It's funny you say that. I'm the opposite. I've been playing golf for years, and I've just started running, and I'm getting addicted to that runner's high. I run 3 miles or something. Not a fast pace or anything, but it feels great, especially during COVID, and so there has been a silver lining through the whole pandemic, which is more time with loved ones, and kind of branching out into these other interests. James, where for people who want to keep up with your ideas, with Horizon's, work, where can they do that?
Sure. So just our website's a really great resource where I should have mentioned this before, but the partners at my firm are very generous, where they write thousands and thousands of pages of research a year, and They believe that the best way to market our firm is to offer some of that for free on our website. And I think that there's a real treasure trove of really interesting thinking, mostly from Murray Stahl on a number of topics that we've discussed today, as well as many more. And then within that, there's also a subpage for the new fund. The ticker's INFL on the NYSE, which is the Horizon Inflation Beneficiaries Fund.
Perfect. Yeah, and I highly recommend everything that you guys put out on the website. I'm an avid reader of it all. So, James, thank you so much for taking the time to do this. We're going to have to come back maybe in a year or two and kind of see how the economic environment has changed and how the portfolio has fared.
Yeah, this was great. And, I feel like we could have gone on for a couple more hours. But, I look forward to doing this again. And thanks again for having me.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.